Topic introduces factor theory as a framework for understanding how underlying economic and financial risks influence asset prices and expected returns. Rather than focusing on individual securities, factor investing emphasizes exposures to systematic drivers such as market performance, inflation, economic growth, interest rates, volatility, momentum, and value characteristics. According to the topic, assets are essentially bundles of factor risks, and investors are compensated through risk premiums for bearing exposures to unfavorable economic conditions or bad times. The theory highlights that different investors possess different optimal risk preferences and therefore seek varying exposures to factors. Higher exposure to risky factors generally requires higher expected returns as compensation for uncertainty. The Capital Asset Pricing Model, CAPM, is introduced as the foundational single-factor model explaining the relationship between risk and expected return. CAPM assumes that the market portfolio is the only relevant factor affecting asset prices and that systematic risk is measured through beta, which captures an asset's covariance with market returns. Assets with higher betas are expected to generate higher returns because they perform poorly during market downturns and therefore require compensation through larger risk premiums. The model provides important insights, including the benefits of diversification, the importance of holding broad market exposure rather than individual securities, and the equilibrium concept that the average investor holds the market portfolio. CAPM also establishes the theoretical foundation for modern portfolio management and asset pricing. The topic further explains several practical implications and limitations of CAPM. Although the model provides a clear framework for understanding systematic risk, it relies on simplifying assumptions that rarely hold in real financial markets. These assumptions include frictionless markets, homogeneous investor expectations, single-period investment horizons, and universal access to free information. In practice, investors face taxes, transaction costs, liquidity constraints, information asymmetry, and behavioral biases. Investors also possess different liabilities, income streams, and investment objectives, creating heterogeneous expectations and strategies. As a result, CAPM often struggles to fully explain observed market anomalies and return patterns, especially in illiquid or inefficient markets where factors beyond market beta significantly affect asset prices and investor behavior. Topic also expands the discussion by introducing multi-factor models, which improve upon CAPM by incorporating multiple systematic sources of risk. Multi-factor models recognize that economic growth, inflation, consumption trends, and investment styles can all influence expected returns simultaneously. Arbitrage pricing theory, APT, represents one of the earliest multi-factor frameworks and models expected returns as a linear function of exposures to macroeconomic factors. Similar to CAPM, multi-factor models emphasize diversification, equilibrium pricing, and compensation for systematic risk exposures. However, instead of relying on a single beta, these models evaluate multiple factor betas to better explain differences in asset returns across securities, industries, and investment strategies, thereby enhancing explanatory power and improving portfolio construction. The topic also introduces pricing kernels, commonly referred to as stochastic discount factors, SDFs, which represent a more advanced framework for asset valuation. Multi-factor models define bad economic states using a combination of systematic variables, and the SDF summarizes these risks into a single pricing mechanism. Assets that generate positive payoffs during unfavorable economic conditions are especially valuable because they provide protection during crises, causing them to command lower expected returns and smaller risk premiums. Conversely, assets that perform poorly during recessions or high inflation periods must offer higher expected returns to attract investors. The SDF framework therefore connects macroeconomic risks directly to asset prices and helps explain how financial markets price uncertainty, consumption risk, and investor preferences across different economic environments. The final section focuses on efficient market theory and the efficient market hypothesis, EMH, which argue that asset prices generally reflect available information and that consistently outperforming the market is difficult after accounting for transaction costs and risk. However, the topic acknowledges that markets are not perfectly efficient because information can be costly, investors may behave irrationally, and structural or regulatory barriers may prevent arbitrage opportunities from disappearing quickly. Behavioral finance explanations suggest that investor overreaction and underreaction to news can create persistent mispricing opportunities. Rational explanations instead argue that higher returns compensate investors for bearing losses during adverse economic states. Together, multi-factor models, pricing kernels, and efficient market theory provide a comprehensive framework for understanding how systematic risks, investor behavior, and market frictions jointly influence modern asset pricing and portfolio management.